Good evening, ladies and gentlemen. Thank you for joining us tonight. This webinar is partly brought to you by Bursa Academy, where you can unlock a world of financial learning. Bursa Academy is a comprehensive platform that aims to provide investors with a continuous and holistic learning journey. You may access Bursa Academy by scanning the QR code on your screen now, or by going to www.bursaacademy.bursamarketplace.com. Our topic for this evening is BMD FM70 Index Futures Series number 3 of our 3-part series. Tonight's series is called The Complete Game Plan for Trading Index Futures. Ladies and gentlemen, before we get started, questions will be open to you through the chat feature in the Zoom platform. And your questions will be addressed by David Lowe after his presentation during the Q&A session. Please tag your questions by mentioning your name, where you're from, and the question. I repeat, you may type your questions in the chat feature. Please make sure you tag your questions by mentioning your name, where you're from, and the question. Our panelist for the evening is David Lowe. David is a trader and managing partner of Exmodius Trading Group PLT. David has 24 years of experience in Malaysia's listed derivatives industry. Before starting his own consultancy, David helmed leadership positions in futures brokering divisions of major investment banks in Malaysia. David also served as the president of the Malaysian Future Brokers Association between 2018 and 2019. David has also spoken in seminars and workshops to over 5,000 retail traders on trading Bursa Malaysia derivatives, as well as the CME, Singapore Exchange Limited, and Hong Kong Stock Exchange markets. His work includes live market trading sessions and webinars. Without further ado, I will hand the screen to David. Thank you, David.
Thank you, Ryan. Okay, let me get my screen up. Okay, share screen. Okay, I hope everybody can see my screen. Just let me scroll down. Okay, let's get it started. Anyway, thank you, Ryan, for the wonderful introduction. A very good evening to everyone. And thank you, all of you, for joining us in this webinar this evening. I hope everyone is keeping safe and keeping healthy. Okay, we've got a lot of material for you tonight. This is the third of the 3-part series. The last two we'd had in the last 2 months. And before we continue, there's a big thank you as well to Bursa Academy for hosting and sponsoring all these education, investor education programs. Those of you who missed the last 2 sessions, you can still catch it once it's uploaded to the Bursa Academy learning platform. As you can see over here, there's a link. So go up there and you can catch the last 2 sections of the FM70 Index Futures series. So we are going to cover quite a lot of stuff tonight. This is what you'll be learning. Okay, the title, of course, is The Complete Plan for Trading Index Futures. These are some of the things that we will be covering tonight. Of course, how to build a winning plan for trading FM70 futures, including the KLCI futures on Bursa Malaysia derivatives. First, we will talk about defining your trading goals. What would you like to achieve from trading index futures? And from there, how to plan out and what are the ingredients in your plan you need to have in order to put your plan and implement your plan. Okay, we will be talking about investment capital and risk taking. This is a very important subject, how to manage your capital, how much capital to start with. These are all very important considerations when you are, what do you call that, going out and trading the FM70 and the KLCI futures. Okay, also about determining what is the optimal trading exposure. Okay, how much of your capital are you going to put at risk to ensure that you have long-term success, right? And we will also talk about trade review, how to analyze your trading results, so to ensure that your trading plan is on track, right? We will go into one topic which is very important for investors and also for traders, particularly traders in leverage products or index futures. It's about the mindset, okay? The mind traps and how to foolproof your trading game plan by actually identifying where the mind traps are. So let's jump into the material straight. Okay, before we go deep into the material for today, just a quick recap on the product. You saw some of those slides which was panning through before the presentation. Okay, but just a quick recap on the two products that we will be talking about tonight. The FTSE Mid-70 Index Futures, which is called the FM70. It was initially launched in 2018. Okay, and the index futures for FM70 is actually the futures contract giving you exposure to the 70, mid-70 stocks of the index in Malaysia. This was revamped and relaunched in 14th of December last year with some revised contract specifications. As you can see over here, the contract size now is the FM70, mid-70 index multiplied by 4. Right, you've seen some of those slides going through before our presentations, the profit and loss multiplied by 4 and how you got the profit calculations. Okay, so the minimum tick size for the FM70 is 5 points. That means every time it moves in increments of 5 points, and each, of course, because each point is equivalent to 4 ringgit, so 5 points is equivalent to 20 ringgit. Okay, this is something that you keep in mind when you're trading the FM70. So let's go a bit into a detail of the contract specifications. This is the contract specifications for FM70. Each individual index futures or futures contract has what we call a contract specs, and this is a snapshot of the contract specs. It tells you everything about trading the futures contract. So the contract code is FM70. The contract size is, of course, we spoke about that. The index multiplied by 4 ringgit. The trading months, okay, you have a spot month, next month, and next 2 calendar months. So possibly in any one time, you will have 4 contracts traded for the contract. Okay, trading hours are between 8:45 to 12:45 in the morning, and the second trading session is at 2:30 to 5:15. Okay, we have said that the 5 index points, every 5 index points, which is the minimum price fluctuation, is 20 ringgit. Now, just have a look at the margins. Margins are basically what you need to have in your account to trade the FM70. For the outright contract, there's to hold one contract of the FM70, you need to have at least 2,500 ringgit in your account. Okay, so that's the margin required to trade the index futures. To trade a spread on the FM70, which is a strategy we spoke about in session 2, you need only 350 ringgit. Okay, so that's a different, of course, a different strategy, but for normal outright contracts, buying or selling a contract of the FM70 is 2,500 ringgit. Right, so let's move on. This is an example of the calculations. You've seen it already, so I'll go through it rather fast. There are, of course, 2 ways to trade the markets. If you are bullish, of course, you buy the FM70 with the view that the market, the FM70 or the market will go up. Okay, so this is an example of December FM70 futures contract. If you bought at 14,900, and if it goes up to 15,100, then you would have a 200 index points profit. So 200 index point profit will be equivalent to 4 ringgit. multiplied by 200 index points will give you a profit of 800 in value gain. Of course, every time we go in the market, there is possibility that the markets may not go up for you. So if it goes down, as in scenario 2, then if the FM70 were to drop to 14,700, then there will be a loss of 200 index points multiplied by 4, then you would have a 800 ringgit loss, right? So this is an example of holding a bullish position in a market and what will happen if markets go up and if markets go down. Now, if you are bearish on the market, you feel that the FM70 is going down, then you could take a bearish position, meaning that you will short sell the market. You short sell the FM70, and in this example, if we sold the December FM70 futures at 14,900, and if the market actually goes down to 14,700, then you would have a 200 point index point profit multiplied by 4. You would have an 800 ringgit profit. So that's shorting, and then markets actually go down. Now, markets, if it goes up, then the markets will actually go against you. Then in this case, if the December FM70 futures were to rise to 15,100, then you would have a 200 index point loss, right? So in markets where you shorted, if the markets were to go up, then you will realize a loss. So in this case, you have a 200 point loss, and you have a multiplied by 4, you have an 800 ringgit loss in your portfolio. So this is a quick example of calculations of the FM70. Let's move on to recap what is the BM KLCI futures, which is the FKLI. Now, this is the top 30 constituent stocks, the index, which is the top 30 stocks. FM70 was the next 70 stocks, right? Which the 100 stocks actually used to be the components of the KLCI. This KLCI, of course, is the most liquid index futures contract in Bursa Malaysia derivatives. And the contract size is actually the index multiplied by 50. So this is a larger contract. The multiplier is 50 ringgit times the index, and the minimum tick is 0.5 points, which is equivalent to 25 ringgit. Right. This is a very interesting contract as well. This is the main contract on Bursa Malaysia derivatives for index futures. So this is the contract specs. Okay, let me close this window. Okay, this is the contract specs, and FKLI, okay, we've seen that multiply 50. Just take a look at what is the margins required for trading the FKLI, which is 4,002. So slightly more capital required to trade the KLCI futures, the FKLI, because it's a larger contract in that sense, right? The spread margin for trading one pair of the spread strategy for FKLI is 750. Right, just to recap what we spoke the last couple of sessions on the product. So let's now jump into the tonight's program. Right, we will be talking about the complete game. This is what you need to have a complete game. Right, you need 4 things. Number 1, you need to be able to execute a trading system or method with an edge. Okay, all of these 4 points I will elaborate in great detail in the next 1 hour. Okay, number 2, you need to be able to manage your capital and manage the risk of exposure. Okay, the third is you need to be able to implement a good money management plan. Okay, so what does it mean by a good money management plan? We'll look into the ingredients of a good money management plan and how do you identify the various components of how a good money management plan looks like. Okay, and last but not least, how to master the trade psychology. This is trader psychology is a very important subject. It deals with your mind. Okay, we talked about the mind traps just now in the beginning of the introduction, and this is the section that we will talk about mastering the trader psychology. So all these 4 points is needed to have a complete game in trading the index futures, or even the futures, or even in the stock market itself, right? But of course, this is specifically for the index futures, and we'll look at all these 4 elements in regards to trading index futures. All right. Now, before we even go to talk about the trading plan, you need to have a very clear idea of what you want to do when you come into trading index futures or trading futures. Okay. What do you want out of trading? Okay. Is it financial freedom? Okay. Is it a side income. You want to make something on the side to complement or supplement your income. Okay, or you see trading as a gateway to your personal and time freedom. Okay, a lot of times on the on the internet, you see a lot of what do you call that, videos on YouTube and all that, talking about the beauty of trading. You know, and this picture on the right is a guy, you know, sitting by the beach having his pina colada, coconut juice, and looking at the markets. So it's this view of trading that has sort of become very popular, right? So you need to ask yourself, what do you want out of trading? Okay, is that the lifestyle that you actually wish for? Okay, it is possible, of course, to do that, or is it just a side income? Or trading is actually a gateway to financial freedom. So this is something that you need to identify, because the way you, or the trading goal that you have will actually define how you trade. Okay, and what are your return expectations? Okay, so these are very important considerations and questions that you have to ask yourself. Okay, is your return expectations what do you call that, in synchrony with the things or the trading goals you want out of your trading? Okay, and how much time can you put into trading, and the frequency of your trading? Okay, your lifestyle and all that, that will be part of the formula when you define your trading goal. Okay, and it will define what type of trading style as well. Okay, and what is the timeline for achieving the above trading goals? Okay, so these are all, of course, very personal to each and every trader. Okay, each and every trader will have a different requirement out of trading. Okay, and all of it, of course, is possible. It's a matter of how you want to plan your plan. Okay, so in terms of looking at all these trading goals, once you have answers to that, then there will be this trader styles. Okay, then you will have to choose the trader style which is suitable for you. So which trader style are you going to be? Are you going to be a position trader? Okay, a position trader is a guy that holds his position for weeks and months. Okay, so a position trader is very strategic in the way he trades, right? And a position trader would have a very different way of analyzing the market. He will look at long-term trends. Okay, he would look at trends which last for, or as you say, a couple of weeks or a couple of months. You're looking for the large trends. Okay, so is that style something you like to do? Because a position trader will, of course, will be looking at more volatility, possibly because he's taking those large swings in the markets, right? Is that the style that you like? Okay, or are you a swing trader? Okay, the second one over here. Are you a swing trader? You hold your position only for a few days, maximum for a week or two, right? So a swing trader has a very different style. It's a shorter term style, okay, compared to the position trader. Okay, you look for the shorter term trends, okay, perhaps a trend that lasts for a week, okay, or you look for turning points within a trend, okay. The position trader, of course, is looking for the large trend, but a swing trader is looking for those movements up and down within that large trend, okay. So perhaps that's more suitable for some people, okay. Or if you like a more active way of trading, you know, it could be a day trader, or even a scalp trader. Okay, if you're going to put more screen time, okay, you have the time to look at the screen more, because maybe your nature of work or the nature of your business, you can do that. Okay, so you have the time to look at the screens. Then you can consider doing your trading as a day trader or a scalp trader. Okay, so basically a day trader holds positions only for the day. So let's say, for example, he comes in the morning today and looks at the FM70. Of course, he would have made some analysis yesterday before the market opens. Then he looks for the opportunities that within the day. So he's basically trading the momentum. Okay, it could be an event, or it could be some data which is coming up, economic data coming up today. He may be looking for momentum where he can take advantage of the daily volatility. So that's the day trader. Also for the scalp trader, okay, which is very similar. Scalp trader is even faster, right? He holds position for seconds. Okay, he's really looking for that fast, huge momentum, and he's in the market probably a few times in and out for the day, right? So that's called a scalp trader. And there is, of course, another strategy called the spread trader. okay, we spoke about in session 2. You may go back and look at that. A spread trader basically takes less outright risk in terms of his positions in the markets are sort of hedged because he's buying and selling the contract in different months. Okay, he could buy, say for example, a February contract in the FM70 and sell the March contract of the FM70. So he doesn't have relative absolute movement risk, but he makes the profit from the relative movement between the contracts in February and March. Okay, if you want to have more details on that, just refer back to the second session, and you have that. So a spread trader has a different style as well, and some people like spread trading because in a way it's a less volatile than taking outright positions like swing traders or day traders. So that is something as well. So different styles will be dictated depending on your objectives and your trading goals. Okay, so these are some of the popular trading styles, just to let you know and be aware of. Okay, this is a very important subject. Okay, and this is we are talking about climbing the ladder from novice to expert. Okay, and everybody who comes to trading and go into the markets to learn how to trade, or when we first started, we'll move from the beginner level to the intermediate level to the expert level. Of course, these 3 levels are kind of simplified. There are, of course, different levels in between, but these are the most common way to describe a trader and which level are they trading at. Okay, so for a beginning and novice trader, okay, and just starting out, it's a very different way of trading, right? In terms of looking at, of course, everybody goes into trading to make money, but because the skill level of those just starting out is still not very, very high. The knowledge of the market is still probably very new. Okay, when you're first just starting to trade, especially in trading leverage products, index futures, your first key learning is to avoid making catastrophic losses while you're gaining the experience. Okay, so a lot of people who come in and trade futures, because they don't really learn how to trade futures, they get into it and they trade blindly, and they could actually make quite a lot of losses, and some losses can be catastrophic. So the thing about being a beginner in trading futures is the key is to avoid making catastrophic losses, big losses, because you're gaining experience. Okay, and because a lot of people don't really go out and learn, okay, and that's one of the things that the Bristol Academy tries to do, is to educate, provide education for the traders and investors, especially those new coming into trading, is to give them a lot of knowledge. And hopefully, with this knowledge, they can do better and begin their journey much better. Okay, a lot of traders actually stay at the beginner level because they can't make profits. Okay, and some stay for years. Okay, but if you could stay for years and not make big losses, then you're gaining a lot of experience, right? So in the beginning level, you may not yet be consistently making money. Right, and what do you need to go to the next level? Okay, from beginner, you need practice. Okay, you need exposure to various market conditions. Okay, of course, you need to learn the market knowledge. Get to know the index futures. How does it move, and what are the characteristics of it? Right, and one of the last things as well is also the emotional development. Okay, is very, very important to move to the next level. So for a beginner, the first key is to move to the next level, and to move to the next level without losing a lot of money. So this is something that beginners need to note. Okay, so once you are able to get your game better, then you move on to the intermediate level. Okay, so this is a trader that's moderately profitable. Okay, so what are the roadblocks for a intermediate level trader? Okay, basically the intermediate level trader has a methodology that it's already working, right? He has a money management plan that is already implementing. Okay, and he's moderately profitable, but he's not really fully doing it to the maximum possibility because of emotions. Okay, that's why emotions in trading is such an important subject. All right, so this is one of those hurdles. Okay, trading psychology and mindset is the last barrier for the intermediate level trader to move on to the expert master level. Okay, so this is the key. What you call that barrier from intermediate to the expert level. Okay, and of course, when you get to the expert and the master level, you are already achieving consistent, profitable trading. Okay, that means month by month you are consistent in your profits. Okay, so the difference between intermediate level and the master level is in the intermediate level can make money, but it's very inconsistent. Okay, so he has what do you call that? You have drawdowns, and then you have make profits, and then it's not consistent, right? So and in the master level, of course, is consistent. Okay, you have mastered knowledge and skills. Okay, at that level, okay, you understand your own trading beliefs. Okay, where your own weaknesses are. Okay, you're aware of your own personal psychological strengths, and of course your weaknesses. Everybody have strengths and weaknesses, right? And at this stage is you see how the challenge of going from intermediate to expert, right? Yeah. So this is where it's mainly a mind game, right? So also in the highest levels of sports and all that, it's in terms of the mechanics of, say, for example, if you're playing a piano or you're playing golf, in terms of the mechanics of implementing, playing that song or swinging golf club, you're there, okay? But to consistently win, say, a championship golfer, it's all basically the mind game, right? It's very similar into trading as well. Right, so the expert trader would have able to fully accept the risk as well. Okay, that means he's very comfortable with risk and he has his emotions under control. And when he trades, it's a very carefree attitude. That means he's in the flow, right? So that's at the expert and master level. Right, so everybody goes through this ladder. So in terms of looking at your trading, you must look at yourself and reflect back, which level am I currently at? Okay, and at each particular level, what are the skills that you need to have to move on to the next level, right? So when we're talking about trading systems and methodology, basically there are two methods. Okay, and for those who are beginning to trade or even at the intermediate level, my recommendation is to go on the mechanical approach. Okay, and we will contrast what's the difference. Okay, mechanical approach is basically, if you look at the right side here, it's a approach where it's rule based. Okay, where your entries and exits have certain rules. So if the rules are fulfilled, then you either enter for a trade, and if certain rules are met, you will exit the trade. Okay, so it's a very structured and very disciplined way of trading. Okay, you're basically trying to remove emotions from your trading. Okay, as we said just now, emotions is a big part of trading. Okay, so if you can trade in a mechanical approach, okay, the mechanical approach will be less emotional compared to the other discretionary approach we will talk about afterwards. Okay, so in terms of the mechanical approach in trading, decisions are actually made by the methodology. Okay, so let's contrast it with discretionary approach. What is discretionary approach? Discretionary approach is basically entering and exiting trades based on feel. What do you mean by feel? Okay, if you catch yourself looking, say, at a chart, okay, even discretionary trading, you can be actually trading charts, or you're reading a news report, or you're reading a research report. Then you say, hey, from this report, I feel that, I feel that the market is up, or I feel I can go into this particular trade, long or short. Okay, when you catch yourself saying, I feel, okay, that means the trader, or the decision to trade is made by the trader. Okay. Now contrast it to the mechanical approach. The decision to trade is made by the method. Okay. So there's a big difference there. Now, excuse me. So can discretionary approach work? Oh, yes, of course, discretionary approach can work, okay? But you need to be probably trading at the expert level to be able to successfully pull off the discretionary approach, okay? So if you're already at the expert level, you already have those rules those entry and exits, those discipline already ingrained in you, that you can actually use a discretionary approach because the system is you already. Okay, so for those who are starting out to trade, I would highly recommend that you will use a rule-based entry and exit method using the mechanical approach. Okay, that's my recommendations for those starting out and when choosing a trading system or a methodology to start. Right? Okay. Now, to this big debate about fundamental analysis and technical analysis, let's get this cleared up, okay? But firstly, we say that both fundamental analysis and TA can be useful, okay? Although in the shorter time frame, the fundamental analysis, because the data don't change that much and that quickly, may be less useful if, let's say, for example, you're a day trader or you are a scalper. Okay, fundamental analysis may not be able to help you. And if you look at the table over here, which basically compares the different features, if you look at FA, of course, it focuses on qualitative and quantitative factors. It looks at data like corporate results, financial statements, economic data. And this data don't like change on a minute by minute basis, right? So in terms of fundamental analysis, it tends to be a bit more long-term. So if you are a position trader, okay, FA could be fantastic to decide what setup and where you are going to be positioned, okay? And then you use technical analysis to actually time your entry and exits if you're a position trader, okay? So fundamental analysis may work very well together with TA when you're trading a position trade. But if you're looking at a day trader, of course, then it becomes less relevant, okay? Then technical analysis will be more helpful in terms of looking at charts in a shorter time frame and when you're trading. Okay, so in terms of TA, a lot of traders use TA because a lot of the technical analysis indicators as well can be quantified and can be put into numbers, and it's more easy to design mechanical rules around with technical analysis. Right, so that's why technical analysis is quite a favorite way of trading for the shorter term traders, and especially for trading futures as well. Okay, so if you're looking at trading the shorter time frames or even the intraday or intra-week charts is something that you analyze, then perhaps look at technical analysis and use fundamental analysis as the background for setting up your trade. Okay, so I hope that clears up between fundamental analysis, which is better. Okay, so let's look at the criteria for evaluating a trading system or method. What's a good method? Okay, these are some checklists. Okay, a list of checklists that if you can tick it off, the more checkbox you can tick off, the better, or the better the odds of your trading system is. Okay, so one of the first one is we talked about this now, 100% mechanical system without human or discretionary input. Okay, if you can have that, that is that would be an advantage. Okay, and if you have a back test, okay, that means this mechanical system or method that you're using have a minimum of 5 years back tested results. That'd be good. If you have more back tested results over more than 5 years, even better, right? So the first is mechanical. Okay, 100% mechanical. If possible. Okay. Number two, of course, the trading system ought to be suited for liquid markets, right? In terms of trading, it's always better to trade in liquid markets because you can get in and out of the markets much easier. And if once you're trading sizes, of course, you need to be able to get in and get out of your positions when you're trading sizes. And liquid markets are very important as well. If your trading system is designed to trade illiquid markets and only perform in liquid markets, then there may be a lot of limitations in that kind of system. Okay, so some systems can only perform or have shown to only perform in that kind of markets could be a bit skewed. The results could be a bit skewed, right? So the other thing about the trading system for liquid markets is also because of the slippage and the cost of trading, right? So if every time you go in and out, there's this big difference between the buyer and sellers, the bid offer spread, then you tend to lose a lot of money in terms of that slippage as well. Okay, so the third point when you're considering looking at the trading system is if a trading system is independent of market direction, that means you can trade both bull markets and also bear markets. That will be advantageous, right? And because index futures trading is you can both trade the markets when it's going up, or if the markets are going down, you still have the opportunities. And if your trading system can actually be able to trade both sides of the market, that would be wonderful as well. Right. So the fourth is, of course, robust performance result. This is when you're looking at the results, okay, in real world conditions. That means you take into account the trading cost as well as the slippage we spoke about on point number 2, right? So if you have a trading system that can make money, but after imputing the trading costs, okay, it doesn't make money, then of course it doesn't make sense as well. Right. So the fifth point as well, you need to know the maximum. Okay, this is a technical term. Okay, the maximum drawdown of a trading system. This needs to be able to quantify. That means in terms of maximum drawdown is, let's say for example, you look at a trading system and it's got results for the last 5 years. Okay, this is an important measure. Maximum drawdown is, let's say for example, if because systems don't only go up on a straight line, because markets are such that your trading system may underperform during certain times or overperform during certain times. So during the time when your trading system is underperforming, is how much from the top of that down to that bottom before your equity, that means your money in your account before it goes back up to a new high again. Okay, that's called a drawdown, and that's very important, because a system that draws down a lot can mean that before it has time to recover, or yes, the market comes back and recover, you will be out. You don't have enough trading capital anymore, right? So maximum drawdown is a very important consideration, because it also stipulates in your trading system what sort of capital you need to have to be able to withstand those drawdowns, if you think this trading system is good, right? That is a very important consideration. And lastly, the percentage profitable trades. These are something that a lot of trading system sellers, those who sell trading system, they always emphasize that, they are profitable in terms of winning trades is very high. Okay, but the benchmark for professional traders is if you can get profitable trades in the range of 40 to 60%, that's very, very good and very respectable. Okay, and N, this is an N. Win ratio. What is win ratio? Win ratio is the average profit against your average loss. Is between 1.5 to 2 times or better. Okay. This thing about the profitable trades and the win ratio, we will elaborate later in the next few slides. So if your system can tick off the more of this checkbox as it can, then it'll be have more odds or better trading system. Okay. So this is a quick and dirty way to evaluate a trading system. Okay, so let's move on. Let's talk about what a trading system is or is not. Okay, this is very important, very, very important. Just to dispel some of the wrong ideas people have about trading system. Okay, a trading system can never be 100% accurate or right all the time. This is something you must be able to accept. Okay, and anyone that promises you that his trading system can have 100% or near 100% accuracy, or it's usually pulling a leg, or is trying to really selling something that doesn't represent reality. Okay, just like there's no system. Of course, nobody sells a system that loses all the time, but there's no such system that loses all the time as well, right? Because in trading, if a system can lose all the time, you can just do the reverse. Every time it says buy, you sell, then it becomes 100% system that's accurate. So that's no system like that as well, right? So that's a trading system cannot be 100% accurate all the time. A trading system most of the time may never exceed even 55% in its predictive ability, right? And whilst a winning trading system really actually doesn't require you to have such high predictive ability, and it can still consistently make profits for you with less winning percentages. This is something that a lot of people don't realize, okay? You don't need so high, okay? If you can do 40 to 60%, that is very, very good. Okay. Now, a trading system won't be able to find the exact highs and lows as well. Okay. Some people have a very, what do you call that? A requirement that no, the system must be able to buy high and low. It's impossible. Okay. So a trading system won't be able to find you the exact high and low of the market. Okay. And a trading system also cannot control market price. Is there a trading system that can control market price movement? There's none. Okay. So basically, it's not part of a trading system. And what a trading system is, it helps you find the edge. Okay. It gives you the advantage, the edge, so that you can, on the long term, consistently make profits. Okay. So that is what a trading system does for you, and especially for mechanical trading approach. Okay. So I hope that dispels some myths about trading systems. Okay, let's move on. Okay, let's talk about trading and risk capital. This is a very important subject. Okay, number one, trade only with capital that you can afford to lose. Okay, this has to be true risk capital. You cannot go and borrow money to. Of course, depends on your strategy. Okay, but what I mean is you don't go and borrow money and you on capital that you cannot afford to lose. Because why? When you are trading with capital you cannot afford to lose, your trading psychology is very different. Okay, you cannot trade with a carefree attitude, right? Because you need to repay this basically this capital that it cannot be this capital that you save for your children's education, or a capital that you cannot it needs to pay for the next couple of months rent. It cannot be, because it will have a very negative impact on your trading psychology. And just now we said trading psychology is so important as part of the trading success, right? So only trade with capital you can afford to lose. Okay, understand leverage, and especially in trading index futures and futures, because these are products which are leverage. It can enhance your returns very quickly. And if you are wrong, of course, it can also quickly go into losses. So this is something that you need to understand when it comes to trading and risk capital. You need to have enough capital when you're trading a leverage product. Okay, and don't overtrade. Don't, because that you one FM70 is only 2005. I have 25,000. I go 10 contracts maximum. Okay, no, don't do that. Okay, because you need to understand leverage and its impact on your trading capital. Okay, it's good. The power of leverage is when it goes for you, it really goes very well for you. But there is a negative side. There is a double-sided sword. You need to be able to manage that negative impact. Okay, so a lot of people, when they trade, they don't take it seriously. They take it like a hobby. Okay, so if you want to succeed in trading, you need to approach trading like running a business. Okay, and not a money game or a gambling game, right? So if you are doing coming into trading just like money game or gambling, then most of the time you will find that you will lose your capital. Okay, so on the right side, you can see when a new trader enters the market with money but no experience, right? The odds are he will quickly gain experience by losing money, right? So that's an expensive way to learn how to trade, right? So I wouldn't advise that. Okay, increase your odds by trading a sound methodology, of course. Okay, that can give you a trading edge. Okay, so in terms of talking about risk capital and all that, bear in mind it must be capital that truly you can risk. Okay, you can put at risk. Okay, so that comes to the single most important trading rule. Okay, and that is cut your losses short and let your profit runs. What does that mean? Every time we trade, okay, we need to know where is our stop loss strategy. That means we need to know where our risk is. Okay, because not all trades can be winners. Again, this is very important rule. Okay, always put a stop loss every time you are trading. Okay, so the stop loss will actually act like a what do you call that? When you're driving, it act like the your seat belt to protect you, or the airbags when it protects you, right? Because sometimes we don't get our trades right, and you need to be able to have this safety in case the trade goes wrong, right? The stop loss actually preserve your capital for the winners that will come. Okay, as we said that you can't win 100% of the time. So what do you do if, let's say, that 40% that you don't win, or those trades that don't turn out or turn well for you, then you need to have a stop loss strategy to make sure that you to protect your capital, right? So every time you trade, especially in futures, put a stop loss order every time you go into the market. Okay, and this is the single most important rule when it comes to money management, okay, and risk control of your trading capital. Okay, so let's talk about trading versus gambling. Okay, so what are the differences? Okay, both are taking risks. Okay, but in trading, you're taking calculated risks and you manage the risk. So we spoke about leverage. Okay, you take calculated risk, you have a methodology that have an edge. Okay, and then you manage the risk if that trade doesn't go for you. Okay, that's very, very important. In gambling, okay, you're basically betting on an uncertain outcome, okay, and you're basically playing a game of chance, okay, for the stakes that's available. Now, the casino or the chonka will have the advantage because that's already pre-programmed in the way they operate. Okay, so in terms of trading, you're doing short-term to medium-term. Of course, gambling is basically very short. In trading, we have what we call a planned positive expectation, but in gambling, you have a long-term negative expectation. The casino house edge is already against you, right? So the longer you play, the more money you will lose. Okay. So in trading, if you have a planned positive expectation, and this is very important, okay, you need to have a positive expectation in your trading method. Okay. If it doesn't have, or you don't know what you're doing, then basically there's no difference between trading and gambling. Right. So that's very, very important to distinguish and you know what you're doing. Okay. So in trading, you're trading for a very specific purpose. And of course, your intent is being ahead at the end of every month if possible. Right. And in gambling, a lot of them are playing for thrill or recreation. So do contrast your trading, what you're doing currently. If you already started trading, are you gambling or are you trading? There's a big difference. Okay. Okay, so let's jump into this subject of money management. Okay, this is it could be a bit complicated, but I hope it's not too complicated. There are various concepts in money management. One is called position sizing. Okay, this is one of the key critical factors in money management, and this defines how big a position to take. Okay, let's say, for example, you have 50,000 ringgit capital. How much capital to risk on a trade? Okay, that is called position sizing. Right, we'll go into describing what it is afterwards. The next thing is the expectancy. Okay, expectancy measures are things like profit factor, which is what is the gross profits over gross loss of your system. Okay, so if your gross profit over gross loss is about 1.5, which call it a profit factor, then it suggests that the trading system of yours is quite robust. Okay, it's quite good. Okay, the other thing, of course, which is measured by a lot of people, is the percentage win. People say, hey, I have a system that's 75% winning ratio or profitability I have a system that makes money 80% of the time. People like to use those figures. Okay, and that's what we call the percentage profitable. Okay, the other thing is the win-loss ratio, which is the average profit divided by the average loss. Okay, so a win-loss ratio of 2 or more. Okay, that means that if you win 2 and averagely only lose 1 unit, okay, then you have pretty good, viable, and sustainable trading strategy. So these are the few measurements in terms of money management concepts when we talk about money management. Okay, I will elaborate a bit on that. Okay, but let's jump into this case study. Okay, this is trading results. Okay, and this trading results is taken from a book called The Trading Game. You want to refer to this book. It's a very good book. I will greatly recommend this book for you as well, by Ryan Jones. Right at the bottom over here, you can see Ryan Jones, A Trading Game, Playing by the Numbers to Make Millions by John Wiley and Sons. Okay, this excerpt from one of his trading systems. I'm just taking the results for you to have a look at it. Okay, this is basically what I call the Ryan Jones trading systems, and this is combined results for all 8 markets. He traded all types of commodities and instruments, and these are the results. Okay, so you have things like net profit. What are the winners? He had 243 winners over 422 trades. Okay, so his winning percentage is 57%. Okay, so these are the numbers I put in red so that we can talk about it. Winning percentage 57%. Okay, just now we were talking about 40 to 60%. So this is within the ballpark figure. So his average win is this, average loss is this, and his win-loss ratio, okay, which is average win divided by average loss is 2.8. Okay, so just now we were saying that 2 and above is very good. Okay, so this is average trade. That means average trade is every time your expectancy is 1,230 ringgit every time you go into trade. Okay, so that's a positive expectancy. Largest drawdown, this is what we said just now. You need to know your system drawdown as well. And for this particular composite eight markets, its drawdown is 14,500. Okay, profit factor, just now we said that you can do 1.5 or above is very good. This profit factor is 3.9%. Okay, percentage time in DD, this is percentage time in drawdown. You can see it's, even though this system is so profitable, it also spends 65% being miserable. That means 65% of the time actually he was he was in losses. Okay, his market was below his peak equity, right? And the average drawdown is 3,004. So these are the numbers that you need to have of your trading system. You need to measure this, right? And later we'll talk about reviewing and measuring results. These are very important figures, and especially these two figures here in red. Okay, I want to draw your attention to the right where there's this box over here. And let's talk about break-even systems. Okay, what is a break-even system? Okay, a break-even system is a percentage win of 50%. What does that mean? That means out of 10 trades, you will win 5 and lose 5. Okay, and then your win-loss ratio is 1. You win 1, you lose 1. That means if you lose one ringgit, and win, you win 1 ringgit. Okay. Now, if your system is this type of system, then it's basically wasting time, because you have to pay brokerage. There's a cost of trading. Basically, in the long term, you will lose money. Okay. Although in the system, you are break even, but then you lose money because of brokerage and all the slippages. Right. So this is not really a break-even system in that sense. Right. Now, a very good system, what is the characteristic? Okay, now win percentage is 40%. Okay, a lot of good traders, their win percentage is about 40% only, right? And the win-loss ratio is 2. As we said just now, if you can achieve 2 times win-loss ratio, it's very good. Okay, so this is the figures, these 2 figures for a very good system. Now, almost holy grail system. Wow, this is like very, very rare to have. What are the percentage? Okay, traders would say that if you have a almost holy grail system, you have a win percentage of 50%. Doesn't a holy grail system have something like 90%? Now, this is something that may surprise you. Okay, if you have a win percentage of 50% and a win-loss ratio of 2.5 times, you already have almost a holy grail system. Okay, a lot of people, of course, try to sell you the holy grail system, which doesn't really exist in the real world. Okay, so now let's look at this and compare back to this RJ trading system. His win ratio is 57%. Wow, okay, it's even better than the win percentage, right? 50%, we say holy grail here. And then what's the win-loss ratio? 2.8, and this is 2.5. So you can see over here, RJ trading system has a very, very, very good trading system. Okay, so I recommend for those people who look at these figures and like these figures to perhaps go and check out Ryan Jones trading system. Okay, you can get the book and buy it from perhaps Kinokuniya or Amazon or something, right? So this is just to give you a look at the results and how to analyze the results and what is a good system, what is a bad system, okay, in terms of the figures. So let's jump into trade simulation, okay? We still have some time, so let's go into trade simulation. Trade simulation using a coin flipping illustration, okay? We take a coin, okay? We flip it 100 times, okay? Let's say we play this game and we flip it 100 times. And each time the coin lands on head, you win, okay? And you win $2. Each time the coin lands on tails, then you lose $1, okay? So in this trading system, what is the win-loss ratio? Win-win 2, you lose 1. So the win-loss ratio is, or the payoff ratio, some people say, is 2 to 1, okay? Very good. Okay, we said 2 to 1 is good, right? Now, suppose the probability, suppose this is a fair coin. This is not a loaded coin. This is a fair coin. So out of 100 flips, it's the most likely to do 50-50. Okay, so in terms of talking of this coin flipping illustration as a trade simulation, you have a trading system which is 2-to-1 in terms of payoff ratio and a win percentage of 50%. Okay, I hope we can agree on that. Okay, so if we do this, okay, what is the result after 100 flips? Okay, this is what happens. We flip it 100 times, and this will be the results. Okay, 50 times it will land on heads, which you'll get $2 for every heads, which is a $100 or ringgit, whatever, gain. And then 50 flips will fall on tails. Okay, and this 50 flips falls on tails, you lose $1 each, which is a total of 50 flips, you lose 50, which give you a net gain after the 100 flips of $50. Pretty good deal, right? Yeah. So every time you flip 100 times, I get 50, right? That's very good. And, you know, if you're smart and somebody offers you this game, you want to play it, you know, and you want to play it many, many rounds, okay, many hundreds of times, right? So if you're given an initial capital of $100 and you put $10 on every flip, then after 100 flips, you would have made $500. Okay, very good deal. Okay, now, how can you produce better results with the same game and the same capital? Okay, now if you have this game, somebody walks up to you and play this game. If he's not careful and you're very smart, if you know things called position sizing, okay, the guy that gives you and offers you this game is actually, he can lose a lot of money. Okay, and let's see how that works in the next slide. Okay, so this is trade simulation, same game, but now you change the size of betting. Just now you're betting $10 every time you flip the coin, okay? But now they have 4 options, okay? And 4 different options over here. Each of them have different results. So the first is you put 10% of your total account in your balance of how much you have on each flip, okay? The second, B, puts 25% of his total balance on each flip. Number C is very aggressive. Wow, he puts 40% of all his money he have on each flip. And D is even more aggressive. 51% of all his total money left in his pocket, he will put on each flip. Okay, each of them will have different results. Okay, and this may surprise you. Okay, let's look at A. He puts 10%. After 100 flips, his $100 in capital turned into 4,007. Wow, a lot. What about B? B, after 100 flips, 100 turned into 36,000. Can you imagine that? No, just now we were talking about $500 and we were excited about that. But if you know how to play a game, it can be 36,100. That's why I say a person that offers you a game without knowing what he is doing can lose a lot of money. Okay. And C, because it took a lot more risk, now it comes back to 4,007, which ain't too bad. Okay, but it's taking a lot of risk. But D, taking too much risk, and this is what we call over leveraging and over committing your capital. Is $100 actually lost money. Now he has 31. Okay, now what you can see over here is if you properly size your trades, okay, this is called proper position sizing. Your results can be very different for the same type of trading simulation, the same parameters of trading. Things can change very differently just by changing your sizing. Okay, you can turn a very mediocre system into a winning system. Okay, so this is the power of what do you call that? Proper position sizing. Okay, very exciting, right? Yeah. So in terms of position sizing in trading, you need to be aware. There's this thing called martingale and anti-martingale. Okay, just now the guy who was trading the 10, 25% and all is using what we call anti-martingale. That means you increase your risk only as you make money. But if you lose money, you will reduce your trades, you reduce your exposure. Okay, so I won't go too much into this martingale, anti-martingale. You can check it out again. But martingale is a very common strategy. A lot of people also use it in the stock market. Okay, in the stock market, it's called averaging down. That means if you lose, you bet bigger. Okay, and you keep losing, you bet bigger, and this is very common among gamblers as well. So this is a flawed strategy. Okay, The casinos have already know how to deal with this type of betting style, okay, where he doubles his bet every time he loses, okay. They have things called the table limits and all that, so that you can never successfully implement a martingale strategy for the long term, okay. And martingale is not recommended for trading, okay. So in terms of looking at how to foolproof your trading method, is you basically need to follow the advice of Sun Tzu in chapter 4 of The Art of War. Basically, before you even going into the trading war, you must put yourself beyond the possibility of defeat. Okay, what does that mean? That means your money management and position sizing and your stop loss strategy and your risk management must be so good that your game is almost foolproof, right? So that's a lesson from Sun Tzu, The Art of War, chapter 4. If you have time, do have a read of that. This is a very famous book by the Chinese general, Sun Tzu. I recommend you to read chapter 4 when it comes to talking about trading. Okay, so in summary, when you talk about money management guidelines for trading futures, the first thing to do, especially when you're a beginner, preserve capital while you're learning, okay? Because that is the key to survival, and that's the key to your prosperity as well in trading, okay? Always trade with a stop, okay? That's your risk management thing. That's your what do you call that? Your seat belt, or that is your airbag, okay? Risk no more than 5% of your trading capital on any one trade. Okay, this is a normal measure. Okay, normally people will be 2%, but don't risk more than 5%. Calculate your risk-reward ratio, which is your win and your loss ratio. If it's 2 or more, then you're very healthy. Okay, and remember, if you can use position sizing, increasing size as you profit, decrease size if you have losses, this will ensure that you have dramatic growth in your account. Okay, so this is a summary of the money management guidelines for futures trading. Okay, so now we spoke about looking at the results just now and about your looking at strategy performance. So it's very important to keep statistics. This is something that a lot of people don't do. I highly recommend you to do. Of course, you have your statements from your brokers and all that. You need to put those statements into an Excel spreadsheet and measure. Measure what? Okay, measure these things on the right, which is these statistics, okay? Of course, number of trades is in total. What are your winning trades over the total of trades, okay? What percentages are you achieving? Is it between 40 to 60%? What's your average profit per winning trade? What's the average loss per losing trade? Okay, very important. Payoff win ratio. This is the AV divided by AL, which will give you a win ratio. Very important thing to consider. We're looking at these two figures just now. Look at also your maximum drawdown. Okay, there are a lot of software in the market where you can actually key in all your data in trading, and they will analyze for you instantly. So you can check out all those software that will give you and analyze all your winning trades and all those trade data for you. Okay, and you should be able to at least evaluate results over 50 trades. Okay, and by that you need to keep a trading journal, and we'll talk about trading journals. Very important to keep records and review your trading results, okay? Besides those figures that you have on your statements, okay, which is the trading statistics, look at also your trade entry and exit rationale. Why did you go in to buy and why you took profit at those levels? It's important to note by the side as well, okay? Why did you do that, okay? And what are the emotions or behavior during the trading? Was it a good day for you in terms of emotions? Were you upset or were you happy on that day when you trade? So that will give you the opportunity to have a record of how you feel, okay? This is good if you can put into your trading journal. And also in your trading journal, your risk management discipline. What sort of risk are you taking every time you trade? Okay, so this is very important. Okay, what types of risk are you fully implementing your risk management discipline? Okay, so a lot of traders are actually quite resistant to put in their records because number one, they're embarrassed by the records that they have. Okay, and that's where it is important, to have that mirror to look at yourself and see whether that mirror is broken or not. Okay, so don't avoid doing that. Have an objective assessment of your trading results and behavior, right? And you can always, of course, talk to some of your more experienced traders, or even some brokers are very good to be able to analyze your trading records as well. So seek out their help on this as well. But you need to have the data. You need to have your records to be able to have an objective look at your trading. All right. So paper trading, okay, this is for new traders, and this is highly recommended for new traders. Okay, I have a picture of Mozart here. He's complaining to his mother, do I still need to practice my piano, or is that a piano or a harpsichord or whatever, right? So yes, for those who are new traders, you need to have your practice, right? It's like playing the piano, the skill of trading, like playing the piano or playing golf, right? You need to put in the process of handling all those things. You need to practice, right? There's nothing that can replace practice and experience. And paper trading, and a lot of platforms now have paper trading. You can of course do manual paper trading as well. You are able to trade in a risk-free environment, risk-free in terms of of your money, right? So if you can have this environment where you can size up your trading system or methodology, whatever methodology you are using, then if you can become profitable on paper, okay, then the probability of you be able to do that as well while you practice on paper, to do it on live trading, your readiness is much higher. So for those who are new in trading, or you may not have your risk capital yet, okay, it doesn't matter, especially those of you who are younger, if you aspire to be good traders, don't matter. You can still do your paper trading first, and if you have good results, actually, if you have good results, you can show to people. Some people are willing to fund you on your system as well, right? So this is a very crucial step for new traders. Don't rush into trading yet until you have a good thing going for you. Okay, so even Mozart needs to practice, right? Okay, let's talk quickly. We have some time to talk about emotions in trading. It's a very important subject. Although I don't have really that much time to go through it, but I will go through the important points, okay? Because emotions is something that once you enter a trade, okay, a lot of the logic that you may have in trading flies out the window, okay? Then the emotions of greed and fear will take over. And this is very normal. Every time a person goes in a trade, all these emotions will well up, okay? Especially the fear of losing money and the greed for making more money. Okay, let's look at it. These are the three greatest enemies of your trading. Okay, fear, greed, and ego. Okay, a downfall of all traders. So just now at the beginning of the presentation, we say that to get to the expert level, this guy here, your trading psychology, these three fellas, the fear, greed, ego, are the ones that will stop you from fulfilling your maximum capacity. And it's not an easy task, of course. Even I, have so many years in the market, also, will have this big challenge with these three guys. Okay, so of course, fear of what? Fear of course, people don't like to lose money, right? Greed, okay, greed is very, very prevalent in trading as well. People all want to make money, right? And ego is the worst. One of the worst is, a lot of people want to be right. They find it very difficult to admit their mistakes. Okay, and all these three will play in every time you trade. All these guys will be in your head. Okay, it's a very powerful basic human nature. It's the challenge of trading actually to conquer these three guys. Okay, so quickly run through them. Fear of what? Number one, fear of losing money. Fear of missing out. Okay, this has been since I think a lot of last 1 year. The FOMO, fear of missing out, is one of those biggest things that has driven the markets. We can see how the effects of it. Okay, fear of being wrong. Of course, a lot of people always want to be right. This is part of ego as well, and the fear of leaving money on the table as well. Not cutting losses. This is one of the biggest things about the fear of losing money, is not the ability to cut losses. Not is a measure of whether you can overcome this fear or not. Okay, a lot of people don't like to admit or don't like to lose money. They will continue to hold positions which are against them. Always wait and see. So this is that particular emotions playing on them. Okay. And this is the important thing. We spoke about drawdowns just now. Now, that's the pain of trading. Just now, you look at the RJ trading system, it's spent 65% of the time in drawdowns, okay? That's the pain period. Can you, manage that, okay? Being able to handle losing trades is what really separates these successful traders from the ex-traders who are no longer trading, Okay, so in terms of that, that's why I'd say trading capital is very important. You need to have enough capital. Capitalization and proper risk sizing is crucial when handling drawdowns, which will always happen in any types of trading. No matter how successful your trading system is, there will be drawdowns. So greed, okay, focusing on money only, focusing on the P&L only, okay. When he makes money, he projects, how fast he's going to be a millionaire, okay. When he lose money, then he'll find ways to revenge trade, okay. So this is the emotion of greed, okay. Good traders focus on process, okay. Focus on your methodology, okay, rather than your P&Ls, okay. And if you only focus on greed, then over trading, whether when you're losing money or making money, will be your downfall. All right. So ego is also a very emotional thing. The thing about this is, if you are, this is of course not a criticism of you having good intelligence. A lot of people who trade are highly intelligent, of course, but when you overanalyze things, can instead of acting, you'll be paralyzed. Okay, so if you're a very intellectual person, like to analyze things, it may not be good for your trading, because you don't want to try to figure out things when the trade is in its life. You need to react. Okay, so holding too strong a view as well is this ego thing. You cannot be wrong. You don't want to admit wrong. You hold a losing position. That's going to be bad for your trading. Okay, so the question is this: do you want to be right, or do you want to be rich? Okay, so forget about ego when you're trading. I know it's an easy thing to say, but it's a very difficult challenge to have. All right, so those are the three things that you need to overcome in terms of the trading psychology. Those are the three enemies. Okay, so in the mindset of a successful trader, these are the 6 traits. Okay, number 1, you need to take responsibility for all your decisions and all your outcomes. What does that mean? That means that you cannot be blaming the markets, blaming somebody else's. All your decisions, you have to take responsibility, including the risk that you take every time you trade. Okay, trading is going with the flow. Of course, going with the trend. We spoke about that in section number 2, going with the trend. Okay, going with the flow. Okay, number 3 is understand that the market is not the threat or the enemy. Okay, as we said, the threat or your enemy is actually those 3 psychological enemies. Okay, that the market is not in the threat. You just need to make sure that you're on the right side of the market. Okay, you need to trade without fear. Okay, again, this psychological. Okay, understand the probabilities and your edge. Okay, we address that in the methodology part and the money management side. Make sure that you have all these things sorted out. Okay, and the last one is seeing the markets objectively. Okay, I mean, you're trading the markets objectively, and you're not trading your own imagination of what the market is about. Okay, so these are the mindsets of successful traders. And for those of you starting out, okay, your roadmap to start trading index futures, these are the things that you need to have in place. Of course, you need to open an account with a licensed broker. Okay, the list of licensed brokers are available on Bursa Malaysia Derivatives website. There's a list of the trading participants. Open an account with a licensed broker. Okay, research and learn. See what is the strategy that fits you best. Okay, what are the trading methods that are available and what suits you best. Pick the strategy that you like, then put in your risk capital. Again, I remind you, risk capital is very important. Trade only with capital you can afford to lose. Then you put your money and then start small. Okay, those of you who are new, start with paper trading. Then when you're comfortable, start small and then grow as your portfolio grows. Okay, so we're going to go into the Q&A session. I hope some of you have put some of the questions in the chat, and I'll pass back to Ryan to see what questions we have. Ryan?
Hey, David. Thank you for that wonderful insights. We will open with the Q&A sessions now with some of the questions posted by the audience members during the discussion. Thank you to Albert. He's posted 2 questions tonight. The first question is, with mechanical approach whereby stop loss levels are fixed, but then my problem is admitting to the loss and refuse to execute. This is a mindset issue. How to handle this?
how to handle not being able to take a stop loss. Okay, that is one of the biggest challenges because the psychologists have already studied this phenomena, that the pain intensity of taking a loss is 2.5 times of even making a profit, right? So one of the ways is to remember, okay, firstly, you got to have a system that you're confident of the trading edge. Okay, that means if you execute your particular plan for the next, say, 10 to 20 trades, okay, you will come up in the positive side. Okay, number one, you have to accept that you need to accept the risk. Okay, accept the fact that you cannot win all the time. And we saw just now in the statistics that a good trading system is between 40 to 60 percent win percentage. So let's say, for example, a guy that has a system that trades with say a 50% win percentage. So you're expected to lose half the time, right? So if you accept that that is the characteristic of your system, then you know that half the time you will make losses, right? And when you make losses, you need to make sure that those losses are controlled and within the risk exposure that you have, right? So if you're having the ability of not being able to take a stop loss, yes, it's a mindset, psychological thing we spoke about. There's been fear of losing money. The other thing is you probably don't have a clear idea of how the statistics of your trading system works. So if you understand that your system, the percentage is 50% to 60%, you lose 4 out of 5 times every time out of the 10 trades that you trade. You are fine because every time you go through that trade, okay, you know that you have percentage-wise over the 10 trades or 20 trades, you have your winning trades come in. Right? And the purpose of the stop loss, you need to understand what it is for. It is to preserve your capital for the wins that will come eventually. I hope that answers your question.
Good. And the second question from Albert is, FM70 is very liquid with very thin volume. How to trade?
Okay. So in terms of trading FM70, of course, you can't do the large sizes because liquidity still needs to build in a new contract. Okay. Last time when we first started to trade FKLI in the 1996 and all that, it was a new contract as well. And as brokers, we had a hard time because, in a single day, you're trading only 100, 200 lots, right? Of course, in FM70 and all that, in the smaller contracts where liquidity is less, then you can't do the large sizes. Right. So if you find that you are able to do large size because of the capital that you have, you may put some into FKLI first. Okay. And whilst you learn the movement, get used to trading FM70. Okay. Of course, we need to admit that the liquidity is not there for you to go in and go out in big sizes. But sometimes, certain new contracts will take some time to develop. And as liquidity builds up, then you can trade more or trade bigger sizes. Okay, so I do hope as well, the exchange do hope as well that the liquidity will build up. Okay, they already have market makers there to make sure that in case you need prices to trade, there is possible to trade the sizes. Okay, so as it is, the FM70 will need to build up some liquidity. But if you have a lot more capital that you can do more, you can perhaps also trade the KLCI. I hope that will be a suggestion that you can look into. Back to you, Ryan.
Albert, I hope this answers your question. David, I've seen many adverts on Facebook and YouTube promising fantastic returns by following their systems and methods. What is your thoughts on that?
Okay, that's interesting, right? These days, the AIs, every time you go in and search for a trading system, or you go and look on a YouTube video on trading system, then the next moment there's this guy selling you systems, promising you that you can make a million or make a fortune from day trading. It's very, very common. Okay, and you can also see from the Google ads on the site every time you surf the internet, if you're interested in trading, all this sort of things seems to pop up in your Facebook as well. Now, the first thing, of course, you need to differentiate is this type of people who sell system. Number one, is it a scam or is it something too good to be true? This is first thing that you need to take it out. If a guy is offering you results that are just too good to be true, okay, don't waste your time. Okay, of course you can check it out if you're cheeky enough. Okay, but don't lose money to this guy and pay him for that kind of systems, because from today's presentations you already know that in trading, if the guy promises you, put in your money and there's not much you need to do, and then you can make there's no such thing in this world. Okay, trading it's not. It is simple, but it's not easy. Okay, there's a lot of work. It's like playing the piano, or playing the piano, or mastering playing golf. Okay, so it's a skill, and a skill needs time to develop with practice and experience, right? So a guy that comes up to you and say you can just buy this system and then you can make a million out of it. My question is always, why do you need to sell the system if you can yourself make $1 million a month? Why even sell a system for $499 or something like that, right? So that immediately rings a lot of bells. But that doesn't mean that on the internet they don't have good coaches or good people who actually share with you good trading strategies or good methods to help you develop your trading strategy. Okay, so I would say 80%, 90% of the time, all these false promises, over hyped results, you will be disappointed. I've bought systems over the internet before in the last 20 over years. Systems that promise you 95% win ratio. I bought it before. Okay, I've done it before, and over all these experiences, most of the time, they don't turn out to be good. Okay, so for those of you who see a lot of these YouTube things, you can check it out. Okay, but you can use the measure that we saw in today's presentation to measure, is it exactly what is this guy, and bring that particular system that he's talking about. What is the win ratio? He will normally talk about percentage win very high. Okay, but he'll never talk about this win ratio, the number of profits against his average loss against his average win. Okay, that figure a lot of people don't tell you. Okay, so those are one of those key things to measure out those systems that can work or cannot work in the long term. So I hope that answers the question.
Great. But if I'm just starting out to trade futures, David, and I want to make it big in trading, what is your advice?
I used to think when I was young, I also wanted to be big in trading as well. Okay, so the answer to that question, the question is a trader just beginning out in trading and wants to make it big. Okay, fantastic. So big is the end destination, and beginning is the current situation. So there's a gap. Okay, there's a huge gap between your ability and your particular dream. Okay, and I encourage people to have that dream. That's good for the market as well. And what is in between? So we saw just now the ladder from beginner to expert level, and what is needed over there. Right? We saw that Mozart also need to practice. Mom says, hey, Mozart, go and practice your piano. Okay, so you need to have those skills. You need to have those mindset skills ingrained with you before you can do the big. Okay, so my advice is do things step by step. Okay, if you want to speed up, of course, the process you can. That means you are more intense in your learning. You're more intense in practicing, and then if you do that, you really put your heart into it, then the possibility of getting big is a bit higher. Okay, and of course there's this thing that a lot of people say, hey, trading looks so simple. No, I heard my friends made so much money, right? Don't know, trade what? GameStop? I don't know. But you need to be able to differentiate between beginner's luck and a person that is truly skilled and can make money consistently. So that is a key differentiation between luck and skill. Okay, two are very, very different things. I've heard a lot of stories that people make a lot of money, and I see myself over the last 20 over years in the business. Yes, clients who make a lot of money initially. Okay, initially. After that, can lose more or double of what they want. Okay, so I hope that it's a good ambition to have as a beginner, become big. Your passion in trading is respectable, but please make sure that you learn and cover, and make sure that gap in skill, experience, and mindset skills is, make sure you got that all sorted out. Back to you, Ryan. I hope that answers.
Thank you, David. I certainly feel a bit more inclined to learn a bit about FM70 now. But with that, we have come to the end of tonight's webinar. We want to say thank you to you, David, for presenting and being a panelist, and also to our audience once again for joining this webinar. And You can find this webinar by scanning the QR code on your screen or going to www.bursaacademy.bursamarketplace.com for you to view it again. And you will find series 1, 2, and 3 of this 3-part series for you. And with that, we wish everyone good evening and good night.
Good night, everyone.